Okay, Ken. Thank you so much, Joshua. I think we'll move on to our next speaker, Eric. So just to introduce again, Eric will be speaking a more in-depth look at your personal finance and financial planning for your future. Eric is currently a financial service consultant from AIA. So I'll be passing the floor to Eric.
My name is Eric. I've been in this industry for 9 years right now. So I'm a financial advisor, like I mentioned by Steffi. And let me first congratulate you on your graduation. All right. And well, adulthood is the next movement in your life. And hopefully, you'll find it exciting. All right. So moving on, can I have the next slide, please? Okay. Right. I actually inserted another slide before this. Okay, let me just put in a short disclaimer. All right. So what I'm about to share is actually through my personal. This is actually through my personal advice. All right. And my experience. So I cannot guarantee that all the information right now, as of this moment, is extremely accurate. So I do hope that if you find some of the information misleading or you don't find it quite accurate, you can always double check with the relevant departments that is available on the website or your resources. All right. So moving on, I'll be touching on a few topics, things like CPF if you start working, personal taxation, how does it work, your HDB, housing loan, marriage, retirement planning, passive income through investment. So it's actually pretty heavy topic. So what I'll do is that I'll touch on pretty much of a bit of surface age. So if you want more in depth, I hope that we are able to I hope that we can connect with you and I can share more with you or probably connect with you through Instagram later. I'll share more. So CPF, okay, basically a general information is founded many years back in 1955. It's basically mainly a comprehensive social security. What it does is that it helps you to enable Singapore citizens or PR to set aside, funds to prepare them for their retirement, for their to buy their first housing, as well as some medical insurance and things like that. Then CPF. When it comes to CPF, when you start working, all right, the very first 3 accounts that CPF will actually open up for you is these 3 main accounts. The first one we call it ordinary account. The second one a special account, and the third one is MediSave account. Now the ordinary account is the main bulk in the very beginning, right? It's used to you can use this particular because individual account you can do different. You can access it to use for different usage, and the government only allows you to do certain criteria. Things like the first one, OA in short, all right, ordinary account. You used to pay for your CPF insurance, your investments if you wish to use some for insurance. But the most important part is actually most people use it to buy their first home. All right. Coming next will be special account. Special account, well, it's like you say, it's a SA. SA provides you, government gives you a guaranteed higher interest rate, and they actually it's mainly used for retirement. It's saving up for retirement purposes. And the last one will be MediSave account. MediSave account is mainly for your hospitalization or even to purchase your hospitalization insurance policy, right? What we call MA in short, all right? Okay. Now CPF and how it works. So when you start working, all right, what happens is that the 20% every month will be deducted from your salary, all right, and it will be contributed into your CPF. Now this 20% that is taken out from your account, it's still your own money, all right, and your your boss or your employer will give you another additional 17%. That works out to be a total of 37%. So imagine every month, whatever amount that you make, all right, as a salary, 37% will be contributed into your CPF account. So compounding it, you together with interest, you get a lot of money over the years. All right. So here I set up an example. If you were to get a salary of 3,000, so 20% out of 3,000 will be $600. So you take home $2,000, $600 will go into your CPF account. And at the same time, 17% it will be contributed by your boss, your employer. Now you get a total of 1,110 in your CPF savings each month. All right. Now this is okay. Now out of this 37%, you will be wondering how will it be broken up? So it will be actually be broken up into three main sector. All right. Your OAs, SA, and MA. Now out of this OA, all right, your 37% will be split. 23% will go into your ordinary account. Now, and 6% will go into your special account, as well as 8% going into your MediSave account. All right. So moving forward, all right. So next we'll come on to the topic of personal income tax and how exactly it will work. So now, because if you are a Singapore citizen, of course, working here in Singapore, then that's without a doubt that you'll be taxed on Singapore basis. But if you happen to find work overseas, all right, under the IRS income tax regulation, in general, as a baseline, how they determine whether you are a tax resident here or a tax resident overseas, right? My suggestion is always ask either your financial advisor or get in a tax consultant if things get a bit too complicated. But just on a basis wise, 183 days, as long as you work here for 183 days or more, you'll be considered a tax resident in Singapore. All right. Otherwise, you'll be considered a non-tax resident. Then it'll be a different basis and different workings. So can we have next, please? So for 2020, I mean, IRS has not released for 2021. All right. Based on how usually tax goes is that every year in the first quarter of the year, usually in April, right, you have to declare your income for the preceding year, which means in 2020, you have to declare your income that was earned in 2019, the whole full calendar year from January to December, from 1st January to even you start work in June, they will consider as, you have to declare it, whether how much you make, be it, unless it is 20,000 and below, you do not need to declare. Otherwise, you have to declare, login, it is because personal income tax, do remember, all right, it is a personal obligation and personal responsibility to report to Singapore IRS. If in doubt, always call them up, check with them, or email them, all right? So the dates to file through e-filing, which is internet filing using your SingPass and everything, for 2020 is they have given the date of 18th of April. So usually e-file is or paper filing, which I doubt nowadays people want to do paper filing. Most of the time people do e-filing and they will be given a date. It's usually reflected on the Singapore IRS website. So if you are in doubt, you can always check with irs.gov.sg, like put out in the slide or the very bottom. All right. So income tax, a lot of my clients will always be curious to ask me how much of the tax, right? For resident tax, I can put out here right now is that, you can take a look. It's not a flat rate, all right? It's always going on progressive, all right? Depending on how much you make. There is, the first 30,000, you'll be taxed on 2%, 3.5%, 7%, and so on and so forth. And the highest tax rate is 22%. Now, if you make anything more than, 200,000 to 300,000 a year, sometimes it could be better that you set up your own company and things like that. But then again, that's another story altogether. All right. But this on general scale, this is the tax rate given by the IRS for tax residents in Singapore. All right. So there is a calculator you can find on IRS website. All right. To so-called, if you are curious to estimate how much. I put out an example. If let's say you were to earn a $3,000 income a month, all right, in a year you earn 3,600, excluding, let's say there is no bonus, for example. All right. So next page, please. So out of 36,000, all right, less off, there are certain things called personal relief. That is the part that they will take away. Reduce down your tax. All right. So these are the quite standard, earned income relief, as well as your CPF relief, because CPF is something we should pay. So government actually helps you to reduce down. So they will base on this thing called chargeable income. You will see from here a chargeable income of 27,008. Now, this will be the part whereby government will charge you according to the tax rate that you have seen earlier. All right, 27,000, and they will base on the bracket, and then they will do a calculation that you'll be taxed on 27,008 instead of 36,000. So your net tax chargeable, or your tax, your tax based on your chargeable income will be 27,008, and it'll be amounting to $156. Now, every different year that government do announce certain budget, so there could be certain rebates or something, even like so-called discount per se, right, to be deducted off. But then again, it's always TBC, to be confirmed. All right. So you just have to look out for news. All right. So here are some tips that you can use to reduce down your income tax. All right. Because for personal level, the only way to reduce down tax is through reliefs. All right. So what I would suggest is that if you if you do earn a fair bit and you cross a certain bracket, sometimes you would like to using the Excel spreadsheet, you can actually understand roughly which bracket you are in. If you if you just slightly cross and you wish to lower down, you can always use these few things like your course fees, your donations, which are quite common. All right. And always please take note, donation doesn't mean you donate to tin cans that somewhere walking around Orchard Road and then you drop in $1, $2. Those are not. I mean those are good, but they couldn't record it. All right. So the only way, you have to go through government approved institutions. All right. All those you can be found on IRAS again. If in doubt, always check. You can check in with your advisor. All right. So Cpf Cash Top-Ups as well. If you have extra bonuses, sometimes some people will wish to top up their own. You can use your own cash to top up your personal one, or maybe even your parents' CPF account. Those could also entitle you to reliefs, which could deduct down your chargeable income. Now, this is the next big thing in adulthood. All right, marriage. I'm married for close to 10 years right now. So these, I'm speaking from experience. All right. These are the three main huge base that I strongly suggest, all right, individuals get yourself into, as in, one is mainly financials, the other one is mentally prepared. All right. The three, I split it up into three main huge base. All right. The first one is your financial base. Now, your financial base is what? Because when the first step, is always the commitment of doing your own weddings, and depending on how lavish you want your wedding to be or a simple one, always do a budget with your partner. All right, understand how much your whole wedding cost is going to be, because individually we don't I can't tell how you want your wedding to go. The next thing will be the cost of your new house. All right, your renovation cost, your honeymoon, wedding ring, dowry, all these kind of things. Factor on these things first, because it's the next step in your entire life that you're going to spend this huge amount of money. So plan for it. All right. The next one is about couple base. Now, you couple base, meaning that you because it's a union of marriage is a union of two. All right, you guys will go into a team of two. So you guys have to work really, really hard and work forward no matter what kind of situation will hit. So it's you see, I find, because this is a project that two of you are gonna set, husband and wife gonna set for the rest of your life. So make sure things you have to able to see eye to eye. All right, discuss any concerns on each other's life, be it small or big, or anything. All right. The next one will be emotional based. All right. Conflicts and quarrels is bound to happen. I can guarantee you it. All right. But you have to be mentally, emotionally be mature enough. Don't pick, you can no longer be a boyfriend, girlfriend part whereby, don't speak to each other for 2 days, that kind of thing. As a husband and wife, you can't. So please, my suggestion is you really have to be emotionally be mature enough, and not to, and you don't respond by shouting at each other, or worse still, hit each other and things like that. It's always so it's a maturity that you got to grow it to another whole new level. Next will be, I think I'll be moving into HDB. All right. Most of us will probably buy HDB in their next new as their new housing. All right. So the amount this is a guideline roughly what you'll be looking at. Now, first of all, is if you were to buy, this is projected if you were to buy a brand new BTO, built to order HDB from the government. All right, you got to look at 5% down payment, either through cash or using your CPF money in your ordinary account, as well as legal fees, your home insurance premiums, your renovations, so on and so forth. So the tip here is always remember, set aside emergency funds at least 6 months to cover your mortgages. All right, in event that you get unfortunate retrenchment or loss of jobs, or always set at least 6 months of emergency funds. All right, this is an example. If you were to buy a 3-room flat, all right, we set I just estimate it as 180,000. That doesn't fix. It depends on location, and always check in with HDB for the pricing of the houses. So you'll be looking at you can loan the maximum of 90%. So 90% you'll be looking at 162,000. So out of these 162, they'll be broken out into, you can make your down payment in either cash or CPF. All right. So these are the huge amount that I have listed down. So it's an average, a rough breakdown of your initial cost. They'll be looking at 18,000. But we do remember, this 18,000 is just is a combination of husband and wife, because you need to be husband and wife in order to purchase a HDB. All right. That doesn't mean that this 18,000 is coming out from one single person. It's two, husband and wife. All right. So now, well, I'll be coming to retirement planning. All right. It's a very huge topic altogether. All right. Retirement is the longest vacation in your life. All right. And like it or not, or even believe it or not, it's never too young to start plan for retirement planning. Now, retirement planning wise, do take note, there is always this thing called voluntary planning and as well as involuntary. What does it mean? Because voluntary means that you basically get to choose. You choose, like, let's say I have clients that tell me that I want to retire at 55, no problem. 60, no problem. 65, no problem. That's what we call voluntary. Now, I met especially during this pandemic, I met quite a couple, some couples, worst cases, that they are being forced into involuntary retirement, meaning that they have already attained quite a fair bit of age, and they are being forced out of they basically, put it in short, they lost their job through retrenchments, or in worst case, I've come across cases whereby they're being struck by illnesses and things like that, or certain accidents that they couldn't get to support themselves. So these are what we call involuntary retirement. So you have to plan for these two kind of situation. Doesn't mean retirement. A lot of people think retirement planning is just okay, I want 65, retire. That's the part where I don't want to do anything and things like that. Right. So yeah. So imagine this. All right. Retirement planning at your chosen age. All right. Let's say, for example, 65. The first month you have to get 10,000. Think about it. What would you want to spend on? Probably go on vacation or buy your certain things that you want, or down pay a nice car and things like that. Second month comes down, another 10,000 you receive in your pocket. What would you spend on? The third month comes by, the same 10,000. Month by month, think about it. Every month receiving $10,000, what would you want, or how would you even think of spending it? All right, think about this. Now, the rule of thumb is that how you plan for retirement planning is, well, this is again rule of thumb, 20% of your income for your retirement planning. And when we refer to 20%, is of your gross, not your net. Meaning that if you were to earn 1,000, you take $200 and put it, you use it to plan for your retirement planning, and not after your CPF. All right, there is always a strategy, like later I'll touch on. A lot of people do investments and a lot of they put in investments, and as well as there are a lot of financial instruments in the world that you can actually invest on. So know how to and what to how to plan. All right, because I always advise clients on knowing your strategy. All right, because if you have got no strategy, it's at the end of the day you're reaching nowhere. All right, so I classify mainly into these four huge class of strategy. All right, the first one is know the assets that you can invest on. All right, the risk and return on each asset, your risk appetite. All right, and I call it ABCD retirement investment strategy. All right, the first asset is, of course, everyone knows, is property. Well, HDB is a property that you can make use of. All right, I do share with some of my clients and even assist them to make full use of their property to as an asset to plan for their retirement. All right, so because it's a favorite, especially in Singapore and quite a fair bit in the world as well. But the thing is that the always headache part is costly, and not everyone is able to afford to use this class. The next one, commonly known, is usually shares. All right, which stocks and shares, they can easily be bought over the counter. A couple of $1,000 you can invest in any part of the world. And all right, moving on. The next one will be bonds as well. Bonds, there are investable bonds. Doesn't mean and Singapore government actually does provide bonds as well. But it really depends on it. Bonds is a very what you call that the risk is very limited. All right, depending on who issue. Whether you can buy bonds from governments, you can buy bonds from companies. So depending on your risk appetite as well. So usually the riskier one gives you a higher returns. The fourth one, commodities. We think about commodities commonly, energy, metals, and most of my clients, they like to refer this as they trade in they like to buy into gold or silver. Usually these are a bit common, but as well as right now the bitcoins as well. All right. So moving on, the last one will be cash as well. Cash, we all know, leaving it, putting it in the bank, you are not, but it is very highly liquid. So do know that what kind of classes of assets that you'll be in. So putting in short, next, you have to weigh the risk. All right. So the next, so you're weighing the risk. All right, the return versus your risk. All right, the investment of assets. All right, the higher the risk, the higher the returns. But of course, do your homework. All right, doesn't mean that all high risk. I do have clients invested in some very shady high risk assets, which eventually the returns was quite shady as well. But eventually, yeah. So do understand what you are actually investing in. Right, next. So this is a quick short screen out. You always have to understand the liquidity, the volatility, as well as the yield. How much returns it can come back to, and the riskiness, and how fast you can convert into cash. All right, because you got to weigh them up, because so your portfolio has to always, you got to generate a portfolio whereby you need to understand, because if you put too heavyweight in, for example, property, it's something which you can't convert into cash if any emergency hits and you need cash. So do understand this. So that's why I created a chart. Next, please. On comparison of assets, you may screenshot this. This is where I list down on the five list on property, equities, bonds that I mentioned earlier, and the liquidity as well as the yield. So in general, I do help my clients to match up their portfolio in terms of how what are their portfolio like, in terms of what kind of assets they're invested in, because there is always a weightage. If you're too heavyweight on certain part, you could be sometimes facing a danger when certain things, like unfortunate cases like this COVID hits. All right. So, okay, moving on. So in retirement planning, always remember an illiquid asset in retirement, it's a liability. Understand this. This is a very important factor. Imagine you don't want to be what do you call, be using or holding on to an illiquid asset, all right, during the time when you are in your retirement. Before that, it could be possible. With that wise, the true asset, next please. The true asset actually in during your old age is pure income, meaning you sit back, relax, just like my earlier shot, at the beach or anywhere, and just enjoy pure income. All right, it's entirely pure. You don't have to even think, don't have to bother. You just receive pure income. All right. Now moving on, next is, all right, so think about it. You don't, this is the part where you don't, having the pure income, you don't have to think what happens to my assets, what kind of class of assets that I used to use on during retirement years. You have to make sure that all these are gone past you. All right, so moving down. All right, the strategy is, understand, I use this for I help my clients to strategize using these main two things. We use income generation assets, and as well as income accumulation. This is a strategy where I combine to help my clients to grow their portfolio into the final pot where how they're going to receive their pure income in their old age. Right. The last point in retirement I'll be touching on the ABCD retirement investment strategy. So during your earlier years, like if you're still young, I believe most of you are young, all right, in your 20s, all right, you will definitely most likely go into aggressive mode, all right, like things like investing in equities, stocks and shares, a lot of it really, okay, and as well as properties, commodities, things like that. All right, then you move on to balance curious and defensive during the different years of your life. Not years, but years of your entire portfolio. I'll share on the how to actually equate the equation. Okay, the formula will goes into like can we have the move the next one, please? Now, your term, you have to calculate. This is a simple formula. All right. Understand your term to retirement. Let's say you want to retire at 65, you less off 2 years, the number of years. All right. So put on, for example, if you're 25 years away from your retirement, you less off 2, 23, you divide it by 3. Now, instead of 4, you divide by 3. All right. The fourth one is defensive. So we just have to use the first 3, A, B, and C. All right. So that equates to averagely 7. So imagine if you were to plan for retirement in your later years, probably in your 50s. So if you divide it by 3, you'll be probably only left with like probably 5 or even less, 5 or less years to plan for your retirement planning. So do understand, that's the reason why I always advise my clients to plan your retirement planning, your retirement as early as you can. All right. So you have more years in your ABCD of strategy. All right. So moving on, next will be the definition of passive income. Now a lot of people think passive income through investments. All right. They think that it is the ability of getting to earn money without doing anything. But the actual fact is that you have to make sure that you transfer your strategy into a reliable system whereby with little or no effort, that's where you get passive income. Because let's put it in short, it's like actually putting money in banks also you get passive income, but of course the interest, it's the part where we call passive, but I believe the interest is really low. So I will show you an example moving on. The few types of financial products that you can see. The few types is you can explore into things like stocks or shares, bonds, unit trusts, annuity plans, or even endowment plans from insurance companies. Now, stocks and shares, there are some what we call, you read up, there are things like blue chips, they give dividends. So you can get passive income through that, meaning that, for example, they pay you 10%, all right, annually. All right, so which means that you passive income, meaning that, for example, you invest in this particular instrument. You put, let's say, for example, $1,000, all right, and you put in $1,000 with them, and they promise to give you, for example, 10%. What you get out of $1,000 is $100. So passively, you get this $100 while your 1,000 is with them. So likewise, these are the type of financial products that you can explore into, where they actually give you passively. Sometimes some even give you monthly, quarterly, or even annually. All right. So explore these. These are the few options that there is available in the market. So moving on next, I put in an example of stocks. All right. So for example, this is a well-known stock in Singapore, SQ. I believe most of you known or even flew with them, right? In the thing, the part about stocks, the dividends provided by them is not guaranteed. Always understand there are places. So understand the strategy. So putting money with them, imagine during in their 09 or 20, they give you that. Before that, they announced 30 cents, all right, on per share. Then after that, they moved down into 8 cents. Now for in this year during the pandemic, they are not even declaring any dividend. So imagine that. You have to understand the risk. All right, you can get from very high or probably get to worst case nothing. So this is what happens if you have to understand the instrument that you are investing in. All right. So next is I put in an example that you invest in unit trust. Likewise, unit trust, you can invest in them and they give you passively an income. All right. For example, this is extracted from Fund Super Fund, where you can actually take a look at the different unit trusts that they do invest, do give, extracted from them. They can give you as high as 10%. All right, 10% a year. I'm referring to this is a year, annually. All right, so these are different. So unit trust works a bit more differently. So do understand what kind of instrument you are going through. All right, moving next is, so three things that you might want to understand what you want to see in to invest when you want to get passive income. All right, the safety. Look at how safe the product is. All right, don't go and invest in some dodgy, thing that give you high dividends. So understand what kind of instrument you are going in. Then the second one is the ability to grow. How whether if this investment has the ability to grow, all right, and diversify. Understand the portfolio, whether how diversified are they? Are they country? Are they per individual country or sector they're invested in? How diversified they are. So because diversification, actually entitles you to have your risk being spread out. So you can have a diversification from very risky to very conservative. All right. So of course, the most conservative, you can put it in the bank, almost guaranteed. All right. So moving down next. So to conclude, right, to get passive income through investment is always consistently track your portfolio. Here I write annually, but also it really depends on what you invest in. I have clients who invest in stocks and shares. They basically have to always track it almost every day. All right. So do understand what kind of stuff you are going into. When in doubt, engage your advisor, consultant, or speak to someone who actually who are able to advise you further in depth into this. So I would like to conclude. All right. This is an example that I show my that I help my clients with. All right. So to conclude is this is a situation that I have quite a lot of young graduates that I have been working with. All right. So I help them to analyze. This is the portfolio of this particular individual before he got married and before he's and so what does this chart shows? Because I'll get all the relevant data individual from himself, all right, and plug it into this with his investments and everything. I'll show him how does it conclude when, especially things like you plan for your future. Put it in short, the rate is the age that he runs out of money. So imagine the very first time when he met me, right? he will run out of money at 61, which the first red bar, if you see, does show at age 61, he runs out of money. So after, going through, this is not just a one-time advice that I can give. This person did work with me for a couple of years, I think for 5 years right now, counting. So the next chart will show him that this is the current review that I have went through with him, and this will be showing the situation changed a lot. All right, the green shows the passive income that he's having, that he will receive when he is during his retirement years. And look at it, his money, he do not need to worry at age 88. This is what we call planning and strategize, strategic planning. All right. So but of course, it doesn't end here. We still continue to walk along. Why? Because the ultimate goal for this particular individual client of mine, he wants the yellow part to be eliminated completely by investments or by true income. All right. Because the yellow color portion is the part where he still needs to use his own personal cash. So he prefers to be covered entirely by his pure passive income. This is the part where planning still is in progress. All right. So financial advisors doesn't just do one-time job. All right. They do a lifetime as long as they live or you live. All right. So moving along next. All right. So to conclude, I would like to give you, guys a small present as a gift. Take it as a gift for, usually I only give this to my existing clients, but to, I'm giving you as a graduation gift, all right, this Excel spreadsheet. I believe this, because this has helped quite a fair bit of my clients to do their planning in terms of budgeting. So this spreadsheet actually does have a recommendation on the left as well as your preferred. My recommendation doesn't mean that you prefer it. All right. So you can input your own preferred rate, as well as you can track, basically put it in short. This budget and expense tracking will help you to see, have an overview every month how much and where your money has went into. All right. Can I have the next one? It will show you conclude into a graph whereby it will split into how much you actually spent in your whole past couple of months, or even a past month, on how much you budgeted versus your expense account. All right. So next, please. So these are in-depth. What are the things that you will be able to key in? Things like your payments. Where have your expenses spent into your money? How much money are you receiving as income? How much your expenses, and etc. etc. All right. So this is these are continuing on part 2. So it's a very comprehensive Excel spreadsheet based on my experience that I worked with so many of my clients. So I hope to give this to you. If you would like it, do connect with me through IG. All right, I'm on IG. You can search me on IG. Next one. Yep. Okay. Amos B4. All right. So I'd like to conclude this is that if remember this, all right, if you work hard on your job, you will only make a living. But if you work hard on yourself, you will make a fortune. So think about it. All right. And that's all that I have to share. Thank you so much.
Thank you so much, Eric, for the presentation.